All right, everybody, welcome back to the Cash Flow Chronicles. I'm anticipating this is working. Sorry, I realized that in the background, I did not do some minor stuff. So I'm just quickly in the background adding it so that way some people can get some traction in the background, like tags and stuff like that. But today I just really wanted to cover a little bit of what I've talked about earlier. So, right at like 2 or so Eastern time, I went live to kind of talk through the FOMC notes that came out today for the late July meeting and what the implications are associated with that, and kind of looking a little bit more into the details about it. And so I have some kind of opinions, and then I'll hop into the actual chat itself, so that way people have the opportunity to kind of chit chat with me and get that going. So to really just kind of hit it off the ground, let me give some people some viewage of what actually happened in the markets today. So let me share my screen here. So what we ended up having was kind of a pre-market. So this is 24 hours, right? So here's where the bell actually rang. We kind of started off pretty strong, I guess, flat to slightly up. And then once you got closer and closer to the Fed minutes release, it started to get a little bit more volatile. And initially, when the results were out, it started to kind of get a little bit more bullish, and then it sold out throughout the rest of the day to being down about 0.5%. And we've continued to kind of be a little bit further down ever since the close later on that evening. So, or later on this evening, rather. So, not the best in terms of market reaction, and I have an understanding as to why. Right? I think there's a lot of stuff that's just going on right now. Are things continuing to expand at a decent pace? Are things continuing to look bad to the point where, from an inflation perspective, the Fed's going to continue to raise rates? I didn't even share. Sorry. So just showing basically the midday, it was basically not showing up, and the market kind of sold off towards the end of the day, being about 0.5% down. So where are we, right? And I think there's a lot of material specifically on what the Fed released in terms of notes, and obviously the market reacts to that. Whether different sectors are at risk, or whether or not things are at better shape than what some of the other sectors might be. And so what I can pull up is, let me just, I guess, give a good look at the balance sheet here. One of the things that I looked at earlier, which is really where we've gotten to in terms of where we got to in terms of the maximum amount of balance sheet, or the highest rate that we had on the balance sheet of about 9 trillion. And this was kind of in the mid 2022 timeframe, to a sell off kind of in the Marchish of 2023 to and this is kind of going to be important for these Fed notes, which is why I'm bringing it up. This overnight swaps that we were allowing, kind of $400 billion worth, to kind of happen in the March-April timeframe, associated with some of these regional banks. And I think a lot of people may or may not really know what's kind of going on associated with that. But reality, it was basically just the mark-to-market accounting, where there was a stress on short-term assets or long-term assets, depending on what you were buying, due to the massive increase of interest rates that were going on across the entirety of the US Treasury market. And so with that, it was basically just focusing on regional banks that were buying assets that, unfortunately, if you on a mark-to-market accounting, if they had to sell immediately, would have had to sell at a massive discount. And so that allowed folks to kind of grab $400 billion worth to kind of offset some of that, and allow that money to kind of come onto their books so that they could live out some of the duration of some of those short-term treasuries, or 2-year treasuries, to be able to then pay back the Fed over time. So there's that specific piece. Then going actually into the meeting notes themselves, if I just hide this in particular and share my screen again. Don't show me this warning. It keeps showing me a warning. Let's go to the actual minutes themselves. And there's a lot of different things in here. And if you go to the very front, you'll see like who's actually in attendance, who's kind of like a participant, but not actually driving things. And that's really not where it is. And you can kind of, or not really important, but you can kind of see the underlying sort of developments in financial markets, open market operations. And they go through this whole piece about who's staff and what they think of the economic situation, who's a participant, what's their view of the current operation, and what's really happening associated with that to kind of come up with the statement, which is kind of on the last page of everything. So the thing that I think is most important is to kind of run through this, which is the staff economic outlook. And I kind of read through a lot of the details on an earlier stream at 2 o'clock, but I wanted to kind of share this with you because it's more of like the simplified version as to what it is. And I think this is the majority of what ends up getting written into the statement at the end that Jerome Powell actually speaks to. So basically, the economic outlook that they're looking at, the economic forecast prepared by the staff for the July FOMC meeting, so this is, about 3 weeks ago, was stronger than June projections. And so since the emergence of stress in the banking sector in mid-March, indicators of spending and real activity has come in stronger than anticipated. As a result, the staff no longer judged that the economy would enter a medium-sized recession towards the end of the year. However, the staff continue to expect that real GDP growth into 2024 and 2025 would run below the estimates of potential output growth, leading to a small increase in unemployment rate and relative to its current levels. The staff continued to project that the total and core PCE price inflation would move lower in coming years. Much of that step down in core inflation would be expected to occur in the second half of 2023, and then with forward-looking indicators pointing to a slowing in the rate of increase of housing services prices and core non-housing service prices and core goods prices expected to decelerate over the remainder of 2023. Inflation was expected to ease further over 2024 as demand-supply imbalances continue to resolve. And by 2025, total PCE inflation was expected to be 2.2%, and core inflation was supposed to be 2.3%. Keep in mind, this is before the numbers for all of July came in, because those numbers came in last week, I believe, at about 3.4 or 3.2 or something like that. The staff continued to judge that the risks to the baseline projection for real activity were tilted to the downside. Risks to staff baseline inflation forecasts were seen as skewed to the upside, given the possibility that the inflation dynamics would prove to be more persistent than expected, and that further adverse shocks to supply conditions might occur, meaning that they don't think we're totally out of the woods as of yet, and there hasn't been enough of an established trend line to date to be able to basically verify whether or not we could have a reacceleration of inflation. Moreover, the additional monetary policy tightening that would be necessitated by higher or more persistent inflation represented a downside risk to the projection for real activity. And then it goes on to what the actual participants of the discussion would say. And they would basically say in the discussion of current economic conditions, participants noticed that the economic activity had been accelerating or expanding at a moderate pace. Job gains have been robust in recent months, and unemployment rate remained low. Inflation, although remained elevated. Participants agree that the U.S. banking system was sound and resilient. They commented that tighter credit conditions for households and businesses were likely to weigh on economic activity, hiring, and inflation. However, participants agree that the extent of these effects remained uncertain. Against this background, the committee remained highly attentive to inflation risks. In assessing the economic outlook, participants noted that the real GDP growth had continued to exhibit resilience in the first half of the year, and that the economy had been showing considerable momentum. A gradual slowdown in economic activity, nevertheless, appeared to be in progress, consistent with the restraint placed on demand by cumulative tightening of the monetary policy since early last year and the associated effects on financial conditions. So basically, they're just talking about, they're not out of the woods yet. They definitely want to get to a long-term sort of solution associated with it, but they haven't really been establishing 100% of a trend. Things that were kind of put into this document, it's a 10-page document, and specifically talks about, what the real things are that the committee is going to do, which in this case they raised by a quarter point. They basically are saying here that things are on a good stability. the fear of what was going on with regional banks in the April-May timeframe seems to have subsided and things seem to have strengthened. They were saying that in June, they were concerned about the outflows of regional banks into larger banks, and that has since been paired and has kind of flatlined. They were talking a little bit about as well the commercial and industrial slowdowns that they're seeing in terms of mortgages, not mortgages, sorry, just loans in general, obviously due to the inflated or elevated interest rates and a lot of other things as well. And then what else were they kind of saying? They're saying slowdown in mortgage applications, but housing prices seems to have been back on the rise again, and so they think that the worst is to kind of behind it in terms of any slowdown to the housing markets. And they think that with any additional sort of easing of interest rates, they think that things are going to get only better for those markets. And then the other piece that I thought was interesting, they said that while debt levels inside of homes is continuing to worsen, it's going up at a pace similar to um, wage growth. So basically, I don't know what the exact numbers are, but say that debt increased by 4%, and then wages have increased by 4 to 5% as well. And I remember seeing the 4 to 5% number actually in the document itself. So there was that. But I think it's prudent to kind of just look specifically at. Let me just share again the actual minutes here. So in the discussion about the monetary policy for the meeting, they agreed that the economic activity has been expanding at a moderate pace. They've also concurred that the job gains have been robust in recent months. Members concurred that the U.S. banking system was sound and resilient. They agreed that the tighter credit conditions for households and businesses were likely to weigh on the economic activity, hiring, inflation, but the extent was uncertain. And then members also concurred that remained highly attentive to inflationary risks. And so they're going to, with support of looking at achieving maximum employment and an inflation rate of 2% over the long run, they agreed to increase by a 1/4 point here. They also agreed that a continue of assess of additional information and its implications for monetary policy and determining any additional policy firming that may be appropriate to return inflation back to 2% over time. Members concurred that will take into account the cumulative tightening of monetary policies, the lags of which monetary policy affects economic activity and inflation. And they talked about this pretty extensively on like page 3 or 4 or maybe 5 of this document about how they are starting to really take into account that there is this lag effect of several months and several agencies that take a little bit of time. And so some of the things that they're acting off of are really several months behind. And I think everyone kind of already knew that. And so what they're saying is at this point is like, well, we're acting off of data that's a little bit older. Should we be kind of a little bit like more concerned about that? Are we over tightening at this point? And it kind of seemed a little bit wishy-washy in that respect. Like we understand that we're kind of going down this path, but we can't say that we know what's going to happen for July, but we see trends heading that way. But we have to operate off of the official data that's in front of us and not what we kind of feel. And that was kind of what was coming in one of the pages or one of the parts of this piece of the document. Now I'll finish here with in addition, members agreed to continue to reduce the Federal Reserve's holdings of Treasury securities and agency debt and agency mortgage-backed securities. As described in the previously announced plans, all members affirm that they are strongly committed to returning inflation back to the 2% objective. Members agreed that in assessing appropriate stance on monetary policy, they would continue to monitor the implications of incoming information for economic outlook, and they would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals, which is the 2% inflation goal. Members also agreed that their assessments would take into account a wide range of information, including readings on the labor market conditions, inflation pressures and inflation expectations, and financial and international developments. And then they came out with the actual statement here that was actually approved for the statement to kind of be made by Jerome Powell itself. And so I think overall, it was kind of one of those things where it was a statement, but a non-statement. And at the end of the day, nothing was really said that was too extravagant. They're still raising a 1/4 point. Well, I think what they're trying to say is that things look like they're heading in the right direction, but they're still not 100%. And so it really, to me, while it seems like we're kind of getting there, it also could be the fact that we are in a place where if things really get wild and out of control, like rental pricing or oil pricing or energy pricing, it could be something where it starts to raise inflation rates again slightly. And with that, you could see another half a point or quarter point hike. But to me, it seems like they're in this point where they're waiting and seeing rather than getting, I guess, too aggressive. Um, but to me, from what it seems like, and reading through the entirety of the notes, not everything that I shared with you guys, but I did share with the people that I was reading with earlier at about 2 p.m. Eastern, is it seemed like they're erring on the side of over tightening, where the point that they can let the leash loosen the leash a little bit if things truly do get out of hand. And that's the thing that's kind of exciting to see is like, okay, is this really to the point where we're at? And I think a lot of folks were saying that they anticipate that there's probably another hike put into this, and that the market is really putting into um, account that there might be another quarter point hike to get us to 5.5 to 5.75 in terms of interest rates. And so if that's the case and that doesn't really come, then there could be a little bit of a short-term rally in the upcoming months. But I'm fairly confident that we're seeing something that's way ahead of what the Fed truly anticipated. I think that they were anticipating we're going to be still in the fours by the time that we were kind of getting to the later half of 2023, and we would really only start to be into the threes and twos in the first half of 2024. And so I know initially when things were getting into the 9% inflation range, they were really starting to think that, and this is close to a year ago, they're really starting to think that things wouldn't really get back to normal until 2025. But in reality, to me, I think they're being rather kind of aggressive. They're thinking like the end of 2024 or mid 2024, you're going to be down to 2.3. In 2025, you're going to be down to 2.2. To me, I don't know what they are anticipating as their restrictions in terms of, are they like, how long are they going to be here in terms of keeping things at this rate. To me, here we are in August timeframe. You're really not going to see this full data kind of fully flow through until the October timeframe, like the data that we're kind of seeing in June, July. And so in August, I guess now as well. So to me, I would anticipate that, you'd probably see a 1Q of next year, really to the point where we're actually going to start slightly reducing the collar around the dog's throat, if that makes any sense. But that's just kind of my standpoint. But I think with that, it's it's pretty interesting to continue to watch these sorts of things. I know some people care, some people don't. Some people just want to see what the numbers are that kind of come from it. But to me, I think the verbiage is kind of key. But the problem with some of these documents is that the verbiage is almost like a non-event. They'll say things and they'll say some things are great, some things are bad, and you don't really have an opportunity to truly understand what they're truly getting after. And sometimes it's best to just read those ending statements because it makes it a little bit clearer. It's like they seem like they're on the right path, but they have to kind of go through the motions and get there before they um, really start to pull off any sort of decreases or cuts or anything like that. So it explains the bearish expectation of the market with the Fed believing the soft landing. I think this is just, to me, just an overrun. I mean, if you just pull up the market as a whole, let's just take a quick gander. Um, yes, I said gander. You just take a quick gander of the year to date. I mean, you're up 14, 15%. And if you look from, where we were back in October, we went from 360, 357 to, 356. So 100 points divided by 360, like a 27% run from the lows, 28%, around there. And we're having a slight retracement, right? I don't think that this is bearish at all. Like if you just say where we were, which we got to a close of 457.50. So we're at 439.50 divided by 450. Oops, 457.50. You can't see this, but we're down 4%. So I don't think that that really claims it as a truly bearish movement. Um, and I think that what you need to recognize is that is okay. You know, a 5% pullback is more than okay. Do I think that we're going to stay at 5%? I personally think it would be healthy to see a 10% pullback. And so from like, let's just say the 460 point, if we pull back to the 415 range, I would be okay with that because that would kind of signal a 10% pullback. And I think that that would be very healthy, especially with everything that's kind of going on in the markets, and things need to be a little bit more rebalanced. Um, I could see some money flowing out of tech because we've had a great run up in tech and some of these things. Like Amazon went from the mid 80s to 140 at one point, and now it's kind of back a little bit. And Google did the same. It was like mid 80s to 135, and now it's back down to the 130. So it's, you know, and same with Meta, Tesla. Like you have some of these companies that have just gone on massive runs since the October lows that you're kind of seeing on the screen here, and none of them have really had a breather. Like let's just take it for example. What's a good one? Let's just look at Google really quick. So Google, 1 year. So November-ish time frame, they were in the mid 80s, and they've been on a run to the 120, 128 bill here. Then you look at Amazon. I'm hoping that Amazon shows up. Okay, yeah, just the same window shows up. Lower down the low 80s here, which I was buying, and you went from low 80s to 142. Like let's just take 142 minus 81, so 61, and it was, so you had a 75% increase on that. I mean, deserves a little bit of a breather, if you ask me. I think that, you know, things are a little bit overextended in that respect. You know, granted, yes, it's coming from highs, and you haven't yet reached back to those highs, but you know, on your way back to highs, you need a little bit of a breather. And I think if you're kind of just continuing on, you know, it's not healthy for those markets. And I think something that isn't really talked about much, and I think sometimes people get too much hype, is like even companies that aren't profitable yet have been hugely overextended on a year-to-date basis, like 77% for SoFi. You have people like Open Door, that's up 177%. It was up at 300% at some points. You have Carvana, um, which was up over 1,000 at one point, and it's like these companies, you know, I don't think necessarily make money as of yet, and here they are exploding because they think that the Fed fund rate is going to start to cool off a little bit. And so, is that appropriate? I don't really know. I don't think so. Um, anyway, so going into some of this, so you're saying the Fed is not expecting a recession, whereas many people are. Um, I think a lot of people are expecting a recession. I think the normal person is expecting a recession, but the economic trends aren't reflecting that. And that's kind of what the FOMC said as well. And I've kind of been fairly confident that there isn't one as well. I think if we were to have seen one, it would have been more on the tech side, and kind of walking through the earnings this year with tech. You know, a lot of the layoffs and stuff that they have done is more efficiencies rather than necessities. And what I mean by that is some of these companies, Amazon, Google, they grew so much during the pandemic, doubling their revenue in the course of several years, that now you have this opportunity to kind of say, okay, things are getting tighter. We're kind of slowing down in terms of growth. We're normalizing back down to the normal trend line. We have to take some opportunistic efficiency cuts where where we think we need to, right? It wasn't like a, oh my God, we're going to be unprofitable next quarter, right? I don't think anybody thought that these companies were going to be threatened by profitability. But I think it was, you know, and so I think a lot of people are starting to see these layoffs happen, started to get very scared and very intimidated by that. And then I think a lot of people were like, oh my God, 10,000 people, it's so much. But at the same time, if you look quarter over quarter, Google still hired more people than they let go. So they still ended up a higher employee count than they did in the 1Q earnings call. So, and same thing I think with a lot of companies. So, I think what it might have done is just slowed down the growth rate just a little bit. And I know people probably don't like to hear that, but that's just the reality of things. Um, and so sometimes some of these companies, you have to figure out what mode you're in. And so for like Amazon, for example, when you have to double rate and shipments in such a quick manner, when things go from like a 9%, 10% of e-commerce sales, or sorry, 9 to 10% of all sales in the United States being e-commerce to 14, 15% overnight, it doesn't matter. You get it done, right? And you figure out how to make it profitable later, because a company like Amazon, which has such a large cash generating machine like AWS, cares more about attaining market share and figuring out how to make profitability happen later. They're in it for the long haul. And same thing with, I think, with a lot of these technology companies, is they're more into the market share, the more into the growth, and they'll figure out that tweaking of net margin that they need to make in the long term. For them, I think it's more about creating great solutions. And to me, if some of these companies make 60 billion versus 80 billion by tweaking on some of these, it doesn't matter to me. What matters to me more is the continuous innovation of these organizations. And if it was a company like this is one of the reasons why I don't invest in Apple. While they have a great product, I use their products. The thing that scares me is, and same thing with Google to an extent, is that 60% of the revenue comes from one product, and we saw what happened with BlackBerry. And so with that, it gets you a little uneasy. What if somebody comes out with a new whiz bang phone and, takes out, and you see, people with Huawei phones, sometimes the Samsung phones come out really good before they started blowing up. And that whole ordeal that kind of put a little hamper on Samsung phones for a while. But that kind of gets you a little scared about what's going on in Apple. And to me, I prefer a company like Google that's in so many different avenues, cloud, YouTube, search, advertising, just all these different avenues of growth that can continue to grow at a rather expensive pace. And that's what I care about more than, hey, this company's making a lot of great profit today. So there's just that sort of thoughts. What are you looking to buy if there is a crash? New holdings. If anything, I'm looking to consolidate holdings here for me personally. Um, I talked about it with Hot Chris yesterday, specifically about Pepsi, Johnson and Johnson. While I like those companies, and while I continue to hold those companies for now, I'm looking to be more long-term focused. And while those are great companies for dividends and stability within a portfolio, if you're continuing to try to grow a portfolio, um, it doesn't really feel like for now, with where I am in my career and where I want to get to, that those are the most appropriate. If I were to say call it quits today, maybe it's prudent for me to hold them. And so I still might end up holding them, because they are, if you kind of include a few of these companies, it's not a huge portion of the portfolio, and they could be a foundational piece if I say needed a little bit of income. But right now I don't need the income. So, Joe, what's going on? Ahad, what's going on? Austin, thank you for coming back. Agreed. I do agree. A breather is always kind of necessary. Iceman, what's going on? But other than that, that was just kind of a quick roundup of kind of my thoughts with respect to the FOMC. And I know I did a show earlier, and I know Chris is not here as well. And so it could be a good opportunity for me to, take some questions from the audience if you guys are so much into it. And if not, then I can end it a little bit early and see what happens from there. Did I start my HYPR position yet? No, I don't even know. Let me see. You keep messaging about it, and this is the problem that I have sometimes with it's like people just expect you to kind of know everything. It's like I don't know everything about every company. Hyper fine. Yeah, 142%. Not profitable at the moment, losing money. I don't know. I'd have to look more into the company personally before I start to rely on it. But I am starting to think more and more about if I were to look at other positions and add them to the portfolio. And I think this is a problem that most people have. They just assume like they don't take into account the long term risk, and they'll almost like look at like, oh, but it could 20x, man. It's like, well, it could also go to zero. Like 90% chance it's going to go to zero, a 10% chance it's going to 50x, right? So I think people just turn their blinders off and don't even think about some of that stuff. And I think sometimes people will be like, well, if you like Palantir, you're going to love this. And it's like a company that's 10 years out from being profitable. And the only reason why they went public is to get any sort of money because nobody else would give them money. And it's like there's a difference between, and I talk about this all the time. It's like you have to seriously evaluate whether or not, like, I have this conversation all the time with so many people. It's like you might feel like the 10 to 15x is like your thing, and that's what you're looking for. But it's like if you're really just like on a hope and a prayer that you're going to get this 10 to 15x, it's like it's likely you're not going to get it, right? Or you might have to take several shots in order to get it. And are you going to blow all your money on one versus you could guarantee, a 2 to 3x pretty easy over the course of several years, not several years, probably a decade, and have a lot higher confidence in it, and be more, I guess, aggressive with a position like that. Like now that Palantir is more of a profitable organization, like I could say firmly for a lot of people out there, some people might disagree with this, but now that it's a profitable company, has cash that's adding to the balance sheet, it's like, okay, it might not be that 50x company anymore because it's like a 30 odd $billion company. It might be a 10x from here, but even I'm fairly confident it's still going to be like $100 billion company, right? So if you think about it in that perspective, then you're still going to get a 3.5x pretty likely versus some people that are out there kind of forcing themselves to look for something that's going to be a 50x, and the likelihood of that actually happening is much less. So I don't think people are truly understanding that they're taking that risk on. They just hear or think about how nice it would be, and then at the end of the day they get very disappointed when it doesn't show up in the right metric, and then they sell it, not knowing that it's going to be an extremely volatile ride. And that's the thing that bothers me a little bit, with some of the hype that we do, and why Chris and I kind of focus on the cash flow chronicles piece a little bit more about fundamentals rather than just like hype and all that stuff. Because, for example, I had to literally mute somebody the other day about Velo 3D. Didn't really have any acknowledgement about the company. I was more into Rocket Lab. I'd done my due diligence on Rocket Lab. I thought it would be one of the preferred, if not the preferred small launch company, and they 3D print a lot of their stuff. And this guy kept hammering me about Velo 3D and all their products and all this stuff. And it's like, that's great, man, but they're losing money. And regardless of whatever I said, he was like, but Elon Musk. And so you have these people that are blinded and they just want to talk and chat. And in reality, they don't actually know anything about fundamentals of an organization. And all they care about is, doing this or that to kind of like make it seem like a good investment and hope and pray. But in reality, they're not actually doing what's prudent to actually make themselves look or perform better. Like how many of you guys would actually, and probably many of you guys are not coming into this stream because it's an FOMC talk and because you don't want to really hear about it. You'd rather just kind of know, okay, inflation's 3.4%, 3.2%. Let's go to the next year or next month, and not really dig into the details. And I find that out about a lot of people. They'll just get hyped up. They'll listen to a YouTuber they think is confident, speaking very eloquently, is more likely to be a con man than most. And, just says, oh, he knows what he's talking about. Let's invest. And in reality, most people don't even know how to read a cash flow statement or a balance sheet. And most people in an organization at most of these companies don't know how either. Right. So, truly, if you want to set yourself apart, you really want to know something, you're going to be very dangerous if you have the opportunity to learn how to do that skill. And it doesn't take very long, and it will seriously differentiate you to an extent. And I know there's some people out there that are, I'm a technical trader. I get it. But at the end of the day, I think it's a better thing to be able to know Because I feel like some people say some of these things don't actually trade along the fundamentals, but they have some sort of representation. So anyway, this is just the thought about that. Please take a look at Brookfield Corp. See, the problem is as well when people like recommend these things. If you just say a name, it doesn't tell me what industry it's in. It doesn't like get me enticed at all. It's like, hey man, if you're looking at space, why don't you look at XYZ company? Maybe I'd be a little bit more enticed. But it's like, look at this blah 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 company. I don't know what it is. I don't know what they do, and I'm probably going to be less likely to actually care. So, and that's no offense to you. It's just like I only have so much time to do due diligence, right? And it is what it is. Joe likes to stay under 10 positions. I can understand that. Can't watch it live. Yeah, there's a person well, no, it wasn't even that. That person came in, like some lady named Vanessa was coming into the stream talking about it. And I think it's probably the same person because neither of them have like true pictures. They both have names with numbers at the end of them. And I think it's just some person that's like very bullish on the company. And I'm not saying it's a bad product, but in reality, what's probably going to end up happening is it's going to go belly up and Elon's going to buy it for pennies on the dollar. Like, oh, you don't want to get bought out by me? That's cool. I'll wait till you go bankrupt and then be the highest bidder on everything that you own. Or if anything, he's going to be the one that's issuing all the debt that Velo 3D had to issue. I think they issued like 15% or something of the stock and to convert from convertible debt. And it's probably Elon that's literally like issuing them. Yeah, sure. I'll give you guys money and, give me a 6% annualized yield and I'll take over all the shares in the company and be the only debt that you guys take on, because that means everything gets owed to me if you guys go belly up. So, no, you're good, man. I'm not talking about just you. I think it's just, anyway. Hot Stevie, what's going down? Hope everything is good. But Austin, Reese to dig into the long term, essentially not buy, borrow, die. The portfolio. Yeah, hard assets are a good time. And I was talking about that a little bit earlier. Like they were talking specifically about assets and where they were in the FOMC, and they were talking about commercial assets and how the commercial mortgages are getting tighter than previously kind of expected. And it makes sense, right? I mean, you're in this environment where interest rates are so much higher that it's going to be hard to continually have people. And so some people are going to have to sell some of it's very important if you're investing in a real estate investment trust. And Chris says this all the time. So it's prudent to listen to his advice on this one. But it's prudent to understand where your maturity cycles are for some of these bonds and debt holdings are, because if it's in the coming, say, 6 months, they're going to be having to reissue debt at an elevated price or sell off properties in order to make that work. So I think it's just prudent for anybody to kind of understand if you're investing in some of these companies. Like that's what one of the things that Chris had me going about SLG is like, it wasn't that crazy of a payment cycle that they needed to get through in order to continue operations. And they had a lot of things on the table that they were going to do to continue to, lower the amount of debt that they needed in the short term. So anyone considering Hyperfine, I mentioned, should do their own diligence, understand the risk. I was in early, pulled principal back out after the first double, so I'm in free money now. Okay, there you go. But yeah, I'm trying to think of like what I could go off on many tangents from this, but I think the thing that a lot of people don't realize is like full self-driving it matters to an extent, but to me, I think people think that everybody's still going to have a car. I think everyone thinks that everyone's going to be caring about full self-driving. And to me, I think we're going to lose the amount of cars that are sold in the future, at least for a short time. I think everyone's going to be sharing cars. It might not be tomorrow, right? But in 10 years' time, I think there's going to be a huge trend of sharing cars and people using the cars that they do have as robo-taxis and cars going off. And you have all these people worried about like range and all this stuff. And to me, it's going to be more important that you have large areas or like large central hubs within cities that could charge all your robo taxis at once, because you're going to be having these cars just like driving to and from. The biggest problem with cars at the moment, and I can switch topics if somebody asks a really good question. Problem with cars at the moment is they only have about like a 5 to 10% like operating efficiency. And what do I mean by operating efficiency? Means if you have 24 hours in a day, you're probably only using those cars 5 to 10% of the day at maximum. So 10% would be 2.5 hours a day you're using that automobile. So think about now, if you are only using it 5 to 10% of the day, but you're able to use and send it out to go work for another 40, 50%, how much money you can make off of that, whether it's through Tesla or Uber or whomever. And what you could say is set a program to be like, all I care about is that you are my personal car driving me back home, um, at 5 o'clock. I'm leaving at 5 o'clock today. So make sure that you're charged up and ready to take me home at 5 o'clock. That car takes you home. Maybe you have to go to the grocery store, what have you. But you could program it to take people out. Like as soon as it drops you off at work, it goes and parks itself, or it goes and goes to kind of robo taxi elsewhere. And so with that, I think you're going to see a lot less people owning individual cars. And if it is people owning individual cars, it's probably going to be more of the wealthy or the hustle culture people that own the cars. And if that's the case, most people probably own one car, if not 1.5 cars throughout, I guess, the average American. And so you probably have, I don't even know how many cars, tens of millions, if not hundreds of millions of cars in the United States. And with that, you have a shrinking over time of how many cars are actually being utilized. Less parking spaces, which means more retail, or it means more commercial space, or it means more residential space. And so I think you're going to end up having more cities that are basically, I think, more focused on walkability and things of the like in the long term, because you're going to have more residential areas in those cities because of having less and less cars. But anyway, let me think. We have some questions about, wonder if general culture will look down on people who don't share autonomous cars in the future. I don't know. Good question. Implications of that for real estate too, specifically commercial real estate, won't need to have as many large parking lots. I agree. These thoughts always make me think about people with kids. I agree. And what will their car situations be? I mean, I feel like if that's the case, you'll probably still get in a car with your mom and dad at the same time. You'll probably still go to school at the same time. But say you have a kid that you need to pick up from school. It's like, well, then you could just program it to go pick up the kid from school, drop them off at home. Now you don't have to go and do it, right? You can either, be at home with them, or you could have more efficiencies while you're working, because if you're able to have autonomous driving or robo taxi, where your car drive you to and from, you could still technically be working, right? So you could still be on the meetings. You'll be showing up better. You'll have that efficiency associated with it. And so people will get a lot of time back in that particular scenario. But I don't think people are really thinking about that to an extent. The self-driving play is a class 8 trucking. Maybe class B. Class B trucking, my current top play would be AUR, since they approval to move freight between hubs at first over same routes. Interesting to go to market plan. Interesting. But anyway, unless you guys have any other thoughts about where you want to take this convo, I'll probably shut her down. Really hoping that Chris gets some good R&R. Always love having a good conversation with him. Oh, the car seat thing. That's a good point. Yeah, that's a good point. I didn't really think about the really young kids that need car seats and stuff like that. But yeah, for any of you guys that have some thoughts, if you have any questions about any of these companies, like Palantir, Rocket Lab, or anything like that, that's the companies I mostly focus on. But anyway, there's another piece that I might do, because I think at the end of the day, whenever I talk on Palantir Weekly, I don't think people actually pay attention. I think they just listen to when Chris or Amit or Arnie speak, and they just like ignore the fact that I'm there. I think what I'm going to do is download a lot of the Palantir Weekly material that I've done over the past year and slowly outline a catalog of shorts and videos that I'll release over time to be able to maybe explain a little bit about what I'm doing. And what it might be is kind of a starting point of what Amit's question was or what the thought initially was, and then me kind of going on my monologues, if you will. And so um, I think I think that at the end of the day, sometimes I think people care more about the hype than actual experience to an extent. And a lot of things that I struggle with, personal work, so my work as well as on YouTube, is I'm honest, and sometimes that honesty comes with truth, as you would expect, and that truth comes with risks, and that truth comes with not just blowing people's or blowing smoke up people's asses, to for lack of a better word. And so I'm okay with presenting risk and not just like the whole Dan Ives thing, right? What I meant was, it's like, oh, this is legit, this has to mean 2Q's going to the moon, man, it's got to admit it. And then what happens? Well, Dan Ives doesn't know everything. Dan Ives actually does get on the pod with Amit, and he says, yeah, it was a 1 year price target. And everyone's sitting there like, dude, we're going to 25 after 2Q. And I'm getting reamed in the comment section to be like, no, man, it's a 1 year price target. And, you guys need to calm the F down. And, they cover these stocks over a multitude of years or a span of years, if not forever, just like he's covering Tesla to this day, even though he started covering it in 2018. And it's no hit. I think it's just, people need to sometimes swallow the hype and acknowledge that there's reality that sets in some of these cases. Um, and so, anyway, I think at the end of the day, I hope that you guys enjoy these things. But I do recommend, if you don't know how to already, to truly look at how to read a balance sheet, because it's important. And there's three specific things. And this is one of the reasons why I invested in Palantir early, because everyone was talking about, you know, sorry to always bring it back to that, but it's like people are always talking about, oh, they're losing hand over fist, they're losing money, they're not profitable. It's like they weren't profitable because when you look at it in a net income basis on GAAP measures, they have to include share-based compensation. But it's like, then if you look at the actual numbers, you look at the balance sheet, it's like, wow, they're giving share-based compensation. Got it. So that's dilution. I get it. But they're still increasing in cash in the books. How they're losing money hand over fist if you look on a GAAP basis. So in that respect, it just doesn't make a lot of sense to me. But anyway, at this point, losing followers probably because of the truth, but or not followers, viewers. So probably because of the truth. But anyway, as always, I like to just keep it real. And sorry if that offends some people. It's no hate. It's just differences in opinions and differences in viewpoints and perspectives. And I'd be okay if they told me I was an idiot and they still think that Dan Ives released the 2Q thing just for 2Q, and it was only 2Q, and it was $25 price target for 2Q. Everyone's entitled to their opinion, but I think the majority of the time people are wrong. So anyway, hope that all helps you guys in any sort of way, shape, or form. Hopes that gives you guys a view on my perspective. And next time I'll hopefully be on here with Chris. If not, I'll see you guys again tomorrow. Same time, same place. Cheers.